Well, the quick commerce story in India till 2 years ago didn't have many takers or believers, and cut to 2024, people can't get enough of quick commerce, whether it's investors or the markets, in anticipation of some of these companies going public. Joining me now is the new kid on the block, Aadit Palicha of Zepto. Aadit, many thanks for joining us here on CNBC-TV18. It's always great talking to you. But first up, congratulations, another round closed today. You managed to get 340 million in a follow-on round at a $5 billion valuation from General Catalyst. This on the back of the money that you raised literally 2 months ago at what, $3.5 billion. I mean, how do you go from 3.5 to 5 billion in 2 months?
Firstly, Shereen, it's wonderful to be here. Thanks for having me, and it's wonderful talking to you always. On the round, so simple philosophy on this financing, right? We obviously raised quite a bit of capital. We're a well-capitalized company, but what I say internally is that the number one rule of life is if you've got high-quality partners on the table and good capital, you should always take it. And we couldn't be more thrilled to have General Catalyst on board. They are a legendary Silicon Valley investor. This is their first large investment in India since they integrated with venture capitalists and brought Neeraj Arora on board.
Yeah.
So we're super excited. And Neeraj has been a personal investor in the company since our seed stage days. In terms of how we went from like 3.6 to 4.95-ish over the past 2 months. I mean, look, the company is growing pretty fast, right? So we've grown in that 60-day period since our last financing. We've grown about 20%. Obviously, we're launching a lot more stores, and you might have seen some of the work that we're doing. We launched Nasik, Ahmedabad, Chandigarh. And I think the inflection point is becoming clearer and clearer to the market, and the downside is largely protected for, because like I mentioned last time, we've got 70% of our stores fully EBITDA and free cash flow positive, turning profitable faster and faster. And when investors saw the downside was protected for, and the business was inflecting, it just made for exciting assets. So that's why we got here. So
you said that this round is really another exercise in strengthening the balance sheet pre-IPO. Yeah. And of course, when we last spoke, you talked about the possibility of an IPO in 2026. Yes. So you said you're well capitalized. Are you looking for more funds at this point in time, or this is it for now?
Look, for now, we're not actively looking for capital, even for.
But if some comes your way, you're open to that.
No, look, I would say that, like I mentioned, it really depends on who the partner is, what the reasoning is, where we are at the stage of the company. See, what I'm most sensitive to today is, all these financings, especially as a private company, are largely an execution distraction for management, right? And so, the reason why we took this capital is because it was very quick, diligence was already done. I doubt that there would already be a very quick amount of capital to pick up after this. So, if anything even takes a remote amount of management distraction at this phase of the journey, it's not really worth it. So I would say that the likelihood that we raise more capital in the imminent future is unlikely, but you never know, right?
But you've raised what, over 1.2 billion in the past year and a half?
That's right. Yeah.
And I think it's only PhonePe that's come close to that number in terms of fundraise in the same period. So what does this mean now in terms of expansion? What does it mean in terms of aspiration to move beyond the cities that you currently operate in and expand the dark store network as well as more categories to get into?
Absolutely. So we are expanding. Like I mentioned last time, we're launching a few hundred stores, across the next couple of months in, not just existing cities in the metro cities, but even in tier 2, tier 3 cities. And just to give you an anecdote, right? We launched Nasik last month, right? Nasik is not known to be anywhere close to a metro in terms of a market. Yeah. The stores that we launched there have hit 1,000 orders per day in 6 weeks. It's the fastest that we've ever been able to achieve that. Mumbai, Bangalore, Delhi took 3-4 months to hit 1,000 orders per day. Nasik is coming in 6-7 weeks. And the insight really for tier 2 and tier 3 markets is that customers are underserved. There are no real quality online or offline options for them in terms of price, selection, and quality. And obviously you're giving them convenience. But when we go into these tier 2, tier 3 markets, customers come and tell us that, hey, I actually couldn't find this selection anywhere else, right? Or I couldn't find this quality control anywhere else. And so we think we have an even stronger value prop in those markets. And the cost.
So is that going to now be a priority and a focus in terms of expansion? Because as you said, these are underserved markets, and perhaps with the kind of growth that you've seen in Nasik, for instance, is it changing your mix in terms of prioritization?
Absolutely. So we plan to launch, the idea is to launch at least a dozen cities over the next 2 quarters. And then we'll expand from there. But right now we've got visibility launching a dozen cities, and that includes Ahmedabads, Chandigarhs, Kanpurs of the world, the Vizags of the world, the Indores of the world. So all of that we're launching over the next 2 quarters, and we'll expand from there. But absolutely, so one, we are expanding geographically. Two, in terms of new categories, I'm glad you brought that up because today one of the big things that even for this financing that really got investors excited is that we launched a bunch of new categories last quarter. We're talking about consumer electronics, general merchandise, high utility apparel, and even beauty and cosmetics, right? And so we launched all those 4 categories. Effectively in the first quarter since launch, it's already doing today, the run rate is well over 1,200 crores of scale, right? Annualized, obviously. But in the first 4 or 5 months of launching a category, you get to 1,200 crores of scale and growing 15-18% month on month. It's an unbelievable vote of confidence in the product market fit. So we're very excited about that as well.
I'll talk to you about deepening the product pipeline in just a second, but I want to pick up on what you just said. And I can't remember if it was you or somebody else within the quick commerce community who talked about the fact that what's happening in quick commerce today is what happened with Flipkart and Amazon when they took off, when they really sort of hit that sweet spot as far as the market is concerned. But what was the expectation with quick commerce was that it was going to be low value, low ticket size transactions. Nobody expected that you guys would be delivering on electronics, cosmetics, and so on and so forth. So the lines between e-commerce and quick commerce, where do you draw those?
It's a great question. Look, and I think the candid reality is that we're still figuring out the answer to that question. I think our entire philosophy on selection expansion is what are customers asking, right, for us to deliver. And we can see that in our search data, we can see that in our browse data, we can see that in the feedbacks, and obviously we can see that in one-to-one conversations. But today all the categories we're launching are coming data-driven, what customers expect on the platform. And what I'll tell you, Shereen, that's interesting is that expectation is evolving over time, right? So if you asked me 24 months ago, or just when you're starting 18 months ago, were people searching for Bose earphones, or were people searching for, let's say, Lakme products? The answer is no. But over time, as people got habituated with the service, they actually started expanding their universe of what they search for and hope for on the platform. So, I think it's impossible to tell, right, how many more categories customers will ask for us. But, if I had to think about it first principles, I think there are certain very high consideration categories that we don't have product market fit in, and we would not be interested in doing.
Like what?
Like smartphones, right? Or, for example, high value electronics. Or, for example, long tail fashion, right? Or furniture, categories like that. And so, those categories I'd expect, it's not a binary 0 or 1. I'd expect a lower degree of product market fit versus categories like meat and seafood, like general merchandise, like consumer electronics, and obviously grocery and fresh. So these high consideration, high stakes, high value purchases, that I think we'll have less product market fit in, and we see that in the data. So that obviously is a little bit of a harder line, but in general, consumers are expanding our expectations every day. So,
but speaking of consumers expanding your expectations every day, what's the mix currently, grocery and non-grocery for you on Zepto?
Without going into the specifics, what I'll tell you is it depends on how you define grocery and non-grocery, but it's a large chunk. It's over all like the let's say food items, anything that's non-food, non-fresh, non-meat, etc. That would be about 25-30% plus of the platform in that zone. Again, very, very broad number. But it's growing, like I mentioned, especially these new categories are growing further, and we're trying to figure out, are there more use cases beyond these 4 categories? So for example, we're going deep into meat and seafood as a category, right? But that's obviously, a category that hasn't really been cracked yet in the country.
I'll get to what next on the private label side, so to speak, but I just want to build on, the skepticism with respect to quick commerce was that, look, how are you going to do this? How will the unit economics work? And what's happening today is that it has taken off. There is a clear consumer buy-in, and you just pointed out that at a store level, you're pretty much at break even at this point in time, and that's the kind of numbers that Blinkit is delivering on as well. In fact, it's expected to be the next big thing after Zomato. It certainly got the government looking at you guys. You've got the Traders Association saying this needs to be regulated, it's hurting the small stores, it's hurting the Kirana stores. The commerce ministers come out and said, look, we cannot take pride in the growth in e-commerce, we have to ensure that it's a level playing field. Does that concern you?
So I'll give you a little bit of a long answer, Shereen, if you'll allow me, right? The way that we look at it today is, grocery and household essentials in India, depends on what categories you include, don't include. It's about 650 billion FY23, growing 9% CAGR. By FY29, it becomes 850 billion, right? $200 billion of just incremental consumption. Now, imagine for a moment, just like a fantasy, right? We build a business double the size of Flipkart and Amazon, talking about 30 billion in GMV, right? even if we build a business like that, it is 1/6 of the incremental consumption from FY23 to FY29, right? So our simple answer to that is everybody's going to grow, right? In this, like, modern trade is going to grow, e-commerce is going to grow, quick commerce is going to grow, kirana stores are going to grow. And look, we also deeply believe in empowering local entrepreneurs. We've got hundreds of local entrepreneurs that run stores at Zepto. People that would have been running a restaurant that come in and put a small amount of capital. In some cases, even take loans that we help them with and start their own business and make money out of it. So we believe in empowering the local entrepreneur, and we believe that there's so much incremental consumption to go that even if you build double the size of Flipkart, which is still 1/6 of the incremental scale. And look, most importantly, I'll tell you one last thing, is that really what excites Kevalia and I, and what excites the whole team at Zepto, it's not about the scale or the valuation. I think if we can build a truly exceptional internet company in India that can be benchmarked to the Mercado Libres, the Coupangs, the Nubanks of the world, the Ubers of the world, the Airbnbs of the world, even in China, the Meituans of the world, the Pinduoduos of the world. We build, let's say, a $70-80 billion company that's generating $1 billion of free cash flow. If we could do that, it's going to be a huge moment in the internet ecosystem. It'll be a Flipkart moment times 2. If investors see that you can create this much scale and $1 billion plus of FCF, what you're going to see is financing in this country will 20x in private markets. You'll have, forget about the tens of millions of middle to lower class jobs. You'll have millions of high quality engineering, product manager, data science jobs. And we think we just need to, today the city of Shanghai has got a bigger internet ecosystem than India times 10, plus. And that's not even the biggest city for internet in China. So there's so much growth for the internet ecosystem. We think if we nail it, and there are a couple other companies that could nail it, we could just revitalize the entire ecosystem. And so that's what we're trying to do. And so
I get the fact that you believe that the opportunity for growth and the headroom for growth is enormous from here. But let me talk specifically about the concerns that have been raised. And I would imagine that the government at some point will perhaps reach out to you guys, for consultations, or perhaps not, I don't know. Some of the concerns are that, look, you're being able to offer discounts, and that's putting the kirana store at a disadvantage, that you're bypassing the aggregators and the sort of distributors and dealing with the FMCG companies directly. I mean, how do you respond to that? And if there were to be any intervention on some of these issues, how's that likely to impact you?
So two things, right? Like I mentioned, one, we are effectively running a marketplace. We've got a couple hundred partners. And what we're doing is not really new, right? Like if you look at modern trade, e-commerce, etc., it's all pretty much the same in terms of the back-end supply chain. So I don't think it's unique to us really, like that problem statement. And two, like I mentioned, I also just think that everything that we're doing is basically like unlocking structural leverage in the system, right? Building efficiency in the system. And using that efficiency to actually create higher quality jobs at scale, right? It's a miracle that a company that didn't exist 36 months ago is now employing 70,000 people. And this is quality, formal income that can be tracked. In many cases, it can be taxed, right? It is better than the below minimum wage.
That's going to be your pitch to the government?
No, look, and I think, it's not even a pitch. Like, I'll tell you which I was giving that whole, ecosystem.
No, it's a fair one.
No, I was giving the whole ecosystem growth pitch is because, we actually, in good faith, want to build this country, right? And we think the internet ecosystem has to do that. And so we're not trying to, undercut, we're just trying to do the right thing. And I think the government will realize that. And, our conversations with them have been productive, have been constructive. We're open to feedback. We're open to figuring out how we can make our growth more inclusive. But
when did they last reach out to you on this issue?
Well, I think we've just generally over the past couple of years, across multiple departments, right? Whether it's folks that are involved in capital markets, whether it's folks that are involved in taxation, whether there are folks that are involved in FDI. All of these folks in good faith are asking us, okay, we get the growth, we get the fact you're bringing billions of dollars of capital to the country, we get the fact that you're employing 70,000 people and growing 200%. How do we make this growth more inclusive? In many cases, we've initiated it. So, obviously, recently we don't have active conversations, but we have conversations with them in good faith, and that's the broader point, right? We're a good faith company, right? We want to build for India, and we feel like we're an Indian startup that could help, maybe in a small way.
Now I want to talk about the competitive landscape. It was largely with you coming in, it became a three-horse race at this point in time, but you've now got the incumbents moving into the quick commerce space. I mean, Big Basket, for instance, now moving full tilt into quick commerce. How is the competitive landscape changing? How do you create moats around you? How different is the Zepto customer, for instance, from a Blinkit customer today?
Yeah. Look, I think at the end of the day, this game is about execution. If we execute well, I think we'll build a very large outcome. If our competitors execute well, I think they'll build a very large outcome. I think competition is probably the difference between, again, just hypothetical numbers, between like, $50 billion and $60 billion outcome, that's competition, that's market share. But from 5 to 50 billion, that's execution. And so, we think we're genuinely lucky to have quality consumer internet players that are our competitors that help us be a better company. We learn from them. Hopefully they learn from us. We think if we just put our heads down, execute well, we'll build a large outcome. So far, that's been true. I mean, I think when we started this company early to mid 2021, mid 21 to early 2022, that was the most intense competitive period. And candidly, that was when we were the most vulnerable because we had the least amount of capital. We were an upstart. You had all these large established startups that had already gotten into play, right? But our philosophy then, and as our philosophy is now, is listen, just be heads down, execute well. The outcome will be good if you do that. And
do you feel less of an upstart today?
No, I think it's a good question, but I think right now we're still operating like a 0 to 1 startup. What I tell the Zepto team every day is that we have not made it, right? Like we are not a $5 billion company. We are a $50 billion company in the making if we don't mess it up. That's a simple thought process.
And that's what I want to talk to you about. And this takes me back to a conversation that I was having with Sameer Nigam at PhonePe, and he was talking about building and execution and scale, and the silly stuff, in his words, that sometimes we've seen people do. What is the silly stuff that you are mindful of, that you are avoiding or you have managed to avoid? Yeah. And what's the non-negotiables that has to be done?
100%. And Shereen, I think the silly stuff is essentially allocating capital in low ROI or zero ROI ways, right? Essentially, my job is like an investor, I'm a capital allocator, right? And so my job is to, allocate capital to wherever I see, rigorous paybacks and ROI. And let's say, you launch like 500 markets randomly, right? And like 300 of them are unviable, right? And that's just like capital wasted. There's zero ROI in that capital. Or for example, if you like launch a new business, hastily, you end up sort of blowing up that capital, right? Or if you just go, give 100% of your customer base just like crazy discounts, all that is just like wasted capital because you're not going to get ROI on that over the long term, compounding ROI. I think we've been able to successfully, historically avoid that, which is why if you look at the outputs, with a fraction of the capital that all the other renditions of consumer internet the decade prior, whether it's ride sharing, food delivery, e-commerce, all those other renditions of consumer internet, we've gotten to a scale with a fraction of the capital that they took. And so I'd argue more capital intensive space. So you can see that rigor in execution there because we've spent a very small amount of capital to get to the scale that we're at. If I benchmark, let's say e-commerce, or if I benchmark, let's say ride sharing or food delivery, they were multiple times more capital to get to where we are today. So we feel good about that. I think we have to keep holding on to that now that we've got more capital. If you ask me today, do we have a plan to invest all this capital in a high ROI way? The answer is no. And even if I have XXX cash in bank, I would not deploy a dollar if I didn't, in good faith, believe for our shareholders that it would be high ROI. And today we don't have a billion of investment plan, unfortunately or fortunately.
Yeah. Well, so take me through from a high ROI perspective, as you just pointed out, the priorities for this year, perhaps over the next 2 years. I mean, what is going to be prioritized? Where will you deploy capital? How will you deploy capital?
Look, I think it's two major buckets of investments, right? I mean, the way that we look at it is firstly we have to 10x customer experience across like speed, quality, selection, and price. And we are working on all of them, without going into too many details for obvious reasons, but we've got a lot of work we're pushing on the customer side. That's priority number one of the company. The second priority is how do we build leverage, right? Execution-led leverage, whether that's variable costs improving, whether it's advertising income going down or going up, whether it's CAC efficiency and excellence in customer acquisition, whether it's new categories that are giving us average order value growth, whether it's the scale and sourcing leverage that we'll be able to unlock on the back end, right? All of that we're working on the leverage side, and there's much more beyond that. And then the third bucket for us is investments, right? And the buckets for investments for us today are, let's say, 3 broad buckets. One would be, for example, new stores. Very simple. There's a.
So what's going to be the store count at the end of FY25?
So we think we'll be at least 700 stores by March 2025. That's what we put out there. We think we can do a little bit more, but right now, again, we want to be prudent, right? So we're going to go for 700 by March 2025. If you look at, but could be more, but as we speak, that's the plan. And then obviously, we want to invest in new customer acquisition efficiently. And again, we're looking at the paybacks of all the acquisition that we're doing. And then we also want to invest in new capabilities, right? So, for example, new capabilities like building out a full-fledged software stack for advertising, right? That is a meaningful engineering task that a lot of our peers candidly have already done over the past decade, right? And we are building it from scratch today. And we have to put together the team, the resources, we have to give them capital. And so, that, for example, investing in that R&D and that software build-up is meaningful. So those are the three buckets of investment. These are the three things that we want to do: customer, leverage, and investments.
Let me pick up on the advertising side, because I think when we last spoke, you talked about the fact that the aspiration was to take that number from ad income to about 1,000 crore rupees. On track?
Yes.
Yeah?
Yeah, we're on track. In absolute terms, although I think it could be going faster, and this team is watching, so I think it has to be going faster, but I think, less than 12 months, it'll be over 1,000 crores very realistically. Right now, we will start run rating. Already 600, close to 600-ish. We'll get to 1,000 crores.
So what is the aspiration then? If you said in the next 12 months, or perhaps even earlier, you're going to be able to get to the 1,000 crore mark. What's the aspiration, especially since this is a priority where you are going to be investing your resources in?
Totally. Look, I think the aspiration is, the aspiration is X. Honestly, there's no real number, but I think it obviously is like a percentage of the platform GMV. We think we can scale it to, similar to the best in class, right? The best in class e-commerce players, without naming their names. They in our categories, obviously with a lot of with decades of investment, have been able to get to a very high quality ads product. So we think that let me put it this way, if the platform doubles, I would want ads to at least 2.5x or 3x over the next 2 years consistently. I think we can get it to today 1,000 crores by 2025. If I fast forward to 2027, I think it's very realistic. It'll be a few thousand crores. It'll be hopefully one of the top 10 or if not top 5 performance advertising businesses in the country. Actually, probably top 5 in terms of scale, high ROI, ROAS accretive performance advertising. So we're not a display advertiser. We do display, but our main focus is bidding, search-led advertising, not like the banners and the billboards. So that's the way to
You talked about customer acquisition as well. How sticky is the Zepto customer? I'm a one-app person, so but I imagine the ecosystem that you operate in is not like that. How sticky is the Zepto customer, and what do you do to ensure repeat transactions?
No, for sure. Look, I think the retention is fairly high. It's meaningfully higher than, say, food delivery and ride sharing, and the overall baseline over 6-9 months. So I'd say, look, customers are not particularly loyal at scale. And there's no real loyalty. It's about who gives the best customer experience on the field on that day. If you consistently get a bad experience on, let's say, X player, you move to Zepto. The vice versa is also true. If you have consistently bad experience in Zepto, you move to the other player. Which is why we just focus on our customer experience metrics. And historically, we had to take very tough calls. We were sitting in 2020 to 2023 candidly on the verge of death, right? Capital was not capital efficiency was not like an intellectual a goal. It was like a life or death constraint. And so we had to really constrain ourselves, and there was lots of things that we had to do just to keep customer experience at a decent place while we could capitalize the company. And we did that, and I think now we are really investing in customer experience. So the store launches that we're doing, you'll see meaningful reductions in delivery times because we're densifying our network. You'll see even as we scale, get more and more sourcing leverage. We think we can get more leverage on pricing, for example, which we believe is a vertical of customer experience. And we're also going deeper and deeper into getting fresher and fresher products for customers. So
you talked about pricing and the leverage on pricing, but how much pricing power do you have today? And do you believe that you're going to be able to continue to enjoy that, given the fact that it's a fairly competitive space and you're going to have more competition coming in? How do you ensure pricing power? Because then that brings up the profitability question and whether this is eventually going to work or not.
Yeah, look, I think it's pretty clear it's working, right? You've got in 2.5 years, essentially a couple of months ago, we went from 0 to well over $1 billion in scale, and we got close to EBITDA break even at a company level. There's forget about internet company, there'll be probably zero, large scale, profitable companies, even the settled industries that would have had that scale and profitability curve that quickly. So I think profitability is not really a question. It's more about execution. I think if you look at all our competitors today, the way that we look at it is, all our pricing power, and you mentioned, let's say, discounts and like unfair discounts, etc. All of it is coming from structural leverage, right? Like, today if I'm pricing, a product X, firstly, our partners take those calls, based on what they see their margin to be, but they're not taking calls that are just, hey, let's just like burn money, right? Like everyone today, if you look at, the partners that are running the stores, if 70% of them are profitable and they're operating at like a decent level of price, then it's structural in a way, right? Like it's structural efficiency that's driving that. So we don't believe in like equity capital to fund a customer experience metric, right? Like that's highly unsustainable, and like that's, I think, the mistake of the last decade of consumer internet.
That's what I was going to ask you. Would you call that the big mistake of the previous decade?
I absolutely agree. I mean, see, because it's not sustainable, and I tell you, to give you a sense, right? It is actually the worst allocation of capital that you can make. If you today start saying, I'm going to put equity capital towards pricing unstructurally, right? And I'm going to, give my partners the ability to do whatever they want, and like we're going to give them like, like no constraints, everybody is crazy, who cares about the P&L? That actually is not going to give you, forget about, you're going to get a pop in GMV, but the second you pull that, it will go back down, and you're not even going to get long-term compounding market share. So if today, like, some competitor comes in and just starts randomly, discounting, which, has happened historically in the past without naming names, then, we think it's like a death knell. Like, that's a
no-go.
That's not, it's a no-go because, like, let's say their objective is, let's take market share from Zepto or XYZ. That's like the worst way to get market share because it's not even long term. Like, you're not going to be able to hold on to that market share when you eventually do pull the plug, right? And like, capital is a commodity, right? Like, we will all be able to raise capital, we will all be well capitalized. It's about execution. So eventually you're going to pull back. If the strategy is, hey, 10x more capital, that never really works, right? And you've seen it with modern trade, you've seen it with aviation, you've seen it with, you've even seen it with telecom. Right? That's historically been a theme.
How IPO ready do you feel today? And what are going to be the next sort of pieces that you focus on before you actually get ready to file the DRHP?
Yeah, so I think we've been lucky to have like an exceptional CFO and finance team, and I think we were joking with the team the other day. I don't think that there's a company with such a short life cycle that's completed like such a rigorous financial due diligence for this round. We did like a very rigorous financial due diligence that I think candidly probably did not happen pre-2021 in the internet ecosystem. And even today,
and was that because of the expected IPO?
Yeah, no, it was just because like in general the ecosystem is now a lot more wary about these things, right? And it's a large amount of capital. People want to do their due diligence, which we encourage, right, as a company. Like that's great. And we've got, let's say, Big Four stat auditor. We built exceptional controls, and like so I think one thing that I'm most proud of is that we've controlled the company very well. Like even the boring stuff, right? Pure reconciliations, exits on invoicing, vendor ledger management. Inventory controls, all of that, we've been able to build depth on. But I think so that's one. I think we're pretty close to being, from a controllership perspective, like a decently well-run public company. Obviously not the best in class, but decent. I would say that the focus for us in terms of going public is really, once that bucket gets closed, I honestly think it's just like a matter of when do we see the right sweet spot of, hey, we're inflecting, we think that we're going to get into, harvest significant amounts of, free cash flow in like a relatively short period of time. That's, I think, the right spot to go public. And look, it's a commercial strategic call. I think that happens in, probably sooner than even I anticipated. And, we're a fast company, so we take a call to go public, we go public very quickly, but yeah, I mean, I think 2026, potentially even late 2025 is a realistic timeline, and our focus would be build excellence on controls and make sure that you have a high, it's not about profitability today, it's about, do you have, because, break-even-ish is not what people are betting on. They're betting on, can you generate 300, 400, 500 million dollars of free cash flow in like a reasonable period of time. And so once we see that inflection point, we'll say,
I know you're doing the rounds of the investor conferences, Adit, Goldman Sachs, Motilal Oswal. What are the questions that they're asking you? Are they excited about the anticipated IPO?
Look, I think, fortunately there is excitement. I think, obviously the public guys have less detail on our bottoms-up numbers versus the private guys do. I think, one thing I'd say for sure is that, meeting the ecosystem 2021 when we were just getting started versus 2024, I feel like there's just a much deeper understanding of what quality internet companies look like and what bad internet companies look like. And the questions that are being asked are much deeper, right? So today you'll have discussions on, okay, if the atomic unit of your business is the store, what's the return on equity mechanics of the store? What's the return on equity mechanics for every customer that you're acquiring? What's the CLTV to CAC on that? So you're having really thoughtful, deep conversations, and we've really been excited about the way that public markets not just like understand our business, and I think obviously they're richly valuing this space, but it's not coming from just like some random thought process, right? It's actually coming from like an understanding of the mechanics of this business financially, but more importantly, the value for customers.
And a growing conviction in the fact that this business will actually work and take off, because that wasn't the case 2 years ago.
For sure. Look, I think I would say it's half the business model, but also half the execution, right? I think like folks are, there would have been a very real world 2 years ago when people had skepticism on this business model, and it would have failed. Like if we didn't execute, and it's not just Zepto, it's all the players in the space that did well. We've really just executed a very difficult business model. And we're getting rewarded for that.
Why do you think that's worked? I mean, of course, the big one is labor, and the fact that we enjoy this significant labor arbitrage. Is that the biggest piece in ensuring that this model works here?
It's not really the labor. I mean, if you look at if you look at all the costs as a percentage of sales, and you allocate some of the facts that the margins are a little bit lower, it actually like gross margin percent. People say, oh, in the West, they've got high labor costs as a percentage of sales. They also have high margins, right? So, FMCG today would be 1.5x higher margins there, right? So it's not really that delta. What actually see, economics and product market fit, and sometimes we miss that in the investor world, is 100% customer backward, right? We believe in the Amazon principle of, customer value and shareholder value have zero conflict in the long term. Like they're exactly interlined, right? And so, for us, it's really the customer value proposition. I think Indian customers love hyper-local, right? They love the ability, to have flexibility. People have smaller people don't have pantries in India. They've got smaller household sizes. The penetration of four-wheelers is low. People like buying fresh, which is naturally much higher frequency. All of these things mean that versus the West, where you do have more disposable income, larger household sizes, you've got more processed food versus perishable food. All of that means that in India, the product market fit of the customer is so strong. And what does that translate into in terms of economics? And this is the big blind spot. We're in this position today where we do so much throughput per square foot. We do multiple times more throughput per square foot than even the best offline commerce player in the country. That today, rent as a percentage of sales in any of our partner dark stores is sub 1% or 1-ish%, right? If you look at that for offline grocery, that would be like 5x of that, right, as a percentage of sales. And so that's leverage, and that leverage is not coming from me doing something or the team doing something. It's because customers are giving us so much value in ordering that we get that throughput. And so we really focus on the customer product market fit. If you deliver for the customer, they'll reward you somewhere in the P&L always. That's the way that we look at it.
Well, speaking of the big changes that have happened for you over the last few years, I mean, I think the Hon Rich List is out. And you and Cavalier make it to that list, not as billionaires, but the youngest on that rich list. I mean, as a 21-year-old, how does this fit in your scheme of things in life? Does it make life harder for you?
Yeah, look,
or easier?
Yeah, look, I mean, I tell you candidly, Shereen, both KV and I, we genuinely, like, at this point, it's really never has been and it never will be about the money. Like, we just love building. Like, we grew up as kids building like silly stuff.
You're still a kid.
Yes, still a kid, exactly. But as an even younger kid, right, when I was 13, 14, 15, we loved, especially KV, coding, we loved building basic stuff. And we just love what we're doing every day, so we're super excited about it. And look, even to this date, we've not really gone crazy. Like we're not saying, oh, look at us, here we are, we've made it, let's fly first class, all this. We don't do any of that because it's just like, what's the point? Because at the end of the day, like I said, there are two things that get me excited waking up in the morning. One is we are building an awesome product for customers. We have to get better, but we're building an awesome product for customers. And two, we could really actually help the internet ecosystem in India. And I think that's a win-win for everybody, right? And it's not just us, right? It's some of the quality companies you mentioned, like a PhonePe, like a Zomato. All these companies, if we nail it over the next 3-4 years, we need to have like a China moment in a way, or like a early 2000s US moment where we just like start creating $100 billion companies, $70-80 billion companies. Not like some big grand like silly vision. It's like bottoms up, we can actually build these companies. I think we've got a shot. A couple other companies have a shot.
Do you think we're 5 years, 10 years out from that?
I think I would say 5 years. I mean, 5 years out from that. Like, if that happens, and I've when raising this round, I've spoken to like very large institutional public and private investors, and I can tell you all of them are on the cusp of saying that if we see this level of DPI getting created at scale in India, we are all in. Right? Obviously, that's still happening. Obviously, you can see what's happening with FIIs. It's not going great, candidly, right?
Yeah.
But if they start seeing like, hey, this seems like Alibaba, this seems like Nubank.
Yeah.
Then they're going to go all in. I mean, you will see the internet ecosystem realistically. If today we've got like 2 million jobs in the startup ecosystem, 1 million jobs, that number will go to like tens of millions without exaggeration. So it's like we feel that, all of us as founders, we should just like leave all the distraction, the money, all of that stuff. It doesn't matter. If we just roll up our sleeves, build it, the country will benefit.
But, does it make it harder to build trust? And I'm not talking about work, but I'm talking about personally, socially. Does it make it harder for a young person like you?
Look, I think the good news is that I barely have a social life. I can say the same thing.
Is that by choice?
Zepto. I'm married to Zepto, right? That's the thinking. And I'm in the office.
Do you want to continue that way?
Yeah, I do. In the office we're building in Bangalore, I'm gonna just live in the office, like without exaggeration. Get a bed there. Life is going to be good.
So no work-life balance for you, huh?
No, not for us. I mean, we love what we're doing. Like, it doesn't feel like, it feels like life, right? This, I feel like I am Zepto in a way, right? But yeah, no. So I think, socially, I don't really have a good answer to that question because I've not really gotten there in this phase of life. But personally, I don't think really much has changed. My family still treats me the same way that I am. If my room is a mess, they still give me shit for it and all of that. So it's still the same.
Have things changed in the way that investors interact with you, for instance, or just public perception in general? Because people forget you are 21. I mean, has that changed on the back of what you've been able to do with Zepto? I mean, 2 years ago when you walked into a room versus today walking into a room, how does that feel for you?
I think the benefit of being in Mumbai is that nobody really cares about startups here, like as much as they do.
Which is why you're going to Bangalore.
Yeah. Well, unfortunately, but we love Bangalore. But it's Mumbai really humbles you because everybody only here cares about cricket and Bollywood and politics, right? Nobody really cares about internet. But you go to third wave in Bangalore, KV gets a lot of attention in a third wave cafe in Bangalore, right? So it's no, I think honestly speaking, it hasn't changed much. I think I can't really put my finger on it. I don't think that there's we walk into a room and there's like more gravitas. I don't think we come off as like we don't wear like crazy stuff. We don't look particularly crazy. I mean, I think most people when they probably see me, they feel a bit underwhelmed. Similarly with KV, we're like disheveled and like not that exciting. So no, I think it's fine. There's a small subset of the population that knows us, like the business folks, the startup folks.
Yeah.
And that's a very small subset. Ordinary people rightfully and gladly don't care about us, and that's great. And we'll keep it that way. So that's the way we look at it.
So let me end by asking you, is there a whiteboard in the office somewhere where there is a line that encapsulates the ambition, the dream that you have for Zepto? What does it say?
There is. I have two whiteboards in my office. No, it's like I mentioned, we just want to the ambition is we want to build something crazy for customers, and we want to build like a truly exceptional internet company in India. And I know I keep saying that again and again, but trust me, Shereen, if we do it, if a few other companies do it, it's going to be awesome. It'll be a Flipkart moment all over again in the internet ecosystem. And this time, much higher quality companies will get built. And that's what we want to do. So that's written in my room. I have like a little note in my room which says, don't mess it up. Don't mess it up.
Aadit Palicha, it's been an absolute pleasure. Thanks so much. Congratulations. We wish you all the very best of luck, and thanks very much for speaking to us today. Well, that's it then on this special edition of Young Turks. From all of us here on the team, goodbye. Thanks for watching. Do stay tuned. There's a lot more coming up on CNBC-TV18.